Now, I'm not a big believer in diversification, whether it's diversification of strategies or diversification for diversification's sake, I should say. There's a place for diversification in order to balance your position and to take a more market agnostic approach. And then there's this unbelievable fragmentation that you can put into your trading that will totally ruin your trading. And so I would say that there is this level of diversification that you can go to that kind of proves that you don't want to become fragmented, I guess is the point. So these are the primary pitfalls, I think, of having to be right or taking on that idea. Again, confirmation bias, overconfidence, emotional trading, your inability to cut losses, and ignoring changing market conditions. So let's talk about on the other side of all of this, and that is the power of making money and what it is, what type of approach should you take if you're not going to be right? What is the mindset that you need where you don't have to be right? See, being right means that you're focusing on making money. That's true. But that doesn't mean that you have to chase every potential profit-making opportunity without some sort of strategy. And it also means that you should have the forethought and understanding that the market doesn't give a shit what you think, right? It doesn't care that you think that you must or deserve to make a profit that day. It doesn't. When and where the market is going to give you an opportunity is basically unknowable. Now, you can think that you can get out there and predict that today has a higher probability of winning than not. And I've always been surprised that some of my biggest days are those days that are surprises to me, that I wasn't expecting that. And so that's telling me something. It's telling me that what preconceived notion that I have, or that tunnel or that myopic vision that I have, where I thought was the thing that was going to lead me to success, wasn't ultimately the thing that led me to success. It was something else. So that's really telling you that you need to adopt a completely agnostic approach. An agnostic approach means accepting that you can't predict the future of the market with any kind of certainty. You need to become attached to specific outcomes based on your analysis. You remain open to various possibilities, right? You just don't know. So like, for instance, when I'm analyzing the market for the day, after I put on a trade, I will look at it and say, man, there's like 3 or 4 different possible things that could happen, or probable things. That's the other thing. You need to act in a probabilistic way. There are 3 or 4 different probable ways that this could happen. And within each one of those, I'm going to make in advance a decision on how I'm going to act. And so by putting that out there, you're not putting yourself into a position so that when that situation happens and you're like surprised by it because you didn't anticipate that or you didn't even think about it, that you have to then make some rash decision, which could be less than optimal. And outside of your stated goal that you should stay open to all possibilities and take a market agnostic approach. And in fact, by trading asymmetrically, that is in fact taking that market agnostic approach, we know that we have to be in the game, have skin in the game. That means that we have to be in the game all the time, and we can't afford to put huge risks every time that we're in the game. At the same time, we want to be able to capture those big profits or any profit when they come. So we take a small risk and leave a wide net that gives us a wide plethora or spectrum of possible profits. That way, when whatever profit the market is deciding that it's going to serve up to us, we are willing to accept it. And acceptance is the big key.